briefly about IMF climate-related activities, and then our work on quantifying the magnitude of energy subsidies, and more recent work on quantifying the magnitude of ancillary benefits from carbon pricing. So, I mean, naturally, coming from the Fiscal Affairs Department, we think that fiscal instruments have to be center stage in climate mitigation. By fiscal instruments, I mean carbon taxes or trading systems with allowance auctions, because it's well established that these instruments are the most effective instruments for reducing emissions, so long as they target the right base, emissions, rather than electricity consumption or vehicle ownership or whatever. In addition, they achieve a given emissions reduction at lowest overall cost to the economy, with a critical if here. That critical if is that the revenues are used productively to enhance economic efficiency, most obviously by lowering the burden of broader taxes in the fiscal system. And then thirdly, they automatically balance the environmental benefits against the economic costs, so long as these policy instruments are scaled right, which means pricing the emissions at the environmental damages per ton of CO2. And in addition, we think that engaging ministries of finance, which is our natural audience, obviously, we don't engage much with, we haven't traditionally engaged much with environment ministries, but obviously we have a lot of contacts with ministries of finance. We think that engaging ministries of finance in climate policy debates is very important given their potential role in administration. We see carbon taxes as a very simple and straightforward extension of existing and long-established, well-established excises on motor fuels. In fact, excises on motor fuels are about the easiest of taxes you can think of to administer. So we think that it's pretty straightforward to just build in a carbon charge into those excises and extend similar charges to the supply of coal, natural gas, and other petroleum products. And then obviously, ministries of finance have a critical role, the central role to play in recalibrating the tax system, slightly lowering taxes on labor and capital, and making sure that there's adequate taxation of energy. We're hoping that our technical assistance in the broad area of carbon taxes and green fiscal reform more generally is picking up. This week there's an important mission to China, where the possibilities for environmental tax reform in China is a significant focus of the mission. I'll be going to Costa Rica shortly for a mission on environmental tax reform. A number of my colleagues regularly go to Middle East and North African countries to advise on energy subsidy reform. And in addition, we have a very active, maybe a bit too active from my perspective, but very active conference agenda where we try to bring policymakers and technical experts together to discuss possibilities for green fiscal reform. We work a lot with the United Nations Environment Programme, with the OECD, with the European Commission and CESIFO. We're organizing a conference this fall on energy and environmental, fiscal and regulatory issues. We're working with the Green Growth Knowledge Platform for a conference on green fiscal reforms for next year. We hope to have a shared conference with the South African government on their carbon tax and so on. And then just quickly on analytical products in the climate area. We did a report on mobilizing climate finance for the G20, where our focus was on fiscal instruments, for example, charges on international aviation and maritime fuels. Our recommendations didn't go down that well when we presented it to the G20, as Gib remembers, but I believe in the power of ideas over the longer term. We also have a handbook for policymakers on how to design fiscal policy to mitigate climate change, and we have a forthcoming book that's joint with Brookings and Resources for the Future on design specifics for the United States for a carbon tax in the context of a broader fiscal reform. So let me talk a little bit about work that my colleagues have been doing on quantifying the size of energy subsidies. And they define two notions of energy subsidies. First of all, what they call pre-tax energy subsidies. So mostly this is reflecting the difference between the costs of supplying fossil fuel energy and what fuel users actually pay for that energy. And in 2011, worldwide, the magnitude of these energy subsidies were about $490 billion, with petroleum accounting for 44% of the subsidy, but coal only 1%. So that seems a little bit at odds with what Warwick was saying yesterday. Maybe we can discuss that later. But at least according to these estimates, eliminating these pre-tax energy subsidies is not going to get you too much in the way of CO2 reductions because you're not raising the price of coal relative to other fuels. In addition, about half of these subsidies are from the Middle East and North African countries, the petroleum producers, but only 5% of the subsidies is from advanced countries. So this debate about removing energy subsidies has sort of been the advanced countries lecturing the developing countries. But we think it's more appropriate to use a broader notion of energy subsidies, which takes into account the implicit subsidy from the failure to charge for carbon emissions and other externalities associated with energy use. And when you define this broad notion of energy subsidies, the picture looks radically different. I mean, for one thing, the total energy subsidies worldwide is now $2 trillion, so 4 times as high. So that underscores, I think, that getting energy prices right through pricing carbon emissions and other externalities is far more important than reducing these pre-tax energy subsidies. In addition, coal now, not surprisingly, accounts for a large portion of the subsidies, 60%, because of the failure to charge for the high carbon emissions and air pollution damages from coal. And in addition, the advanced countries now account for 1/3 of this subsidy, underscoring, I think, that energy price reform is a pressing issue, not just for developing countries, but for developed countries as well. So I want to finish up by talking a bit about our some forthcoming work where we've been trying to develop much more refined estimates of externalities from energy use. So we've been quantifying the air pollution damages and various transportation-related externalities, traffic congestion, traffic accidents, and so on, associated with the use of motor vehicles. And we have detailed country-level estimates for over 150 countries. And the motivation for this project was that, our central message on energy policy is that countries need to get the prices right. They need to reflect not only production costs, but also external costs in fuel prices. And it's no good just saying, well, there's this general principle. We have to provide actionable guidance. What does this mean for different countries? So we're trying to lay out a methodology and associated tools so that countries can understand how to quantify the appropriate level of corrective taxes on coal, natural gas, gasoline, and motor fuels. And in a minute, I'll explain what this means for the ancillary benefits of carbon pricing. So just an example of what we were doing, to quantify the air pollution damages, the health damages from coal use, we're estimating pollution exposure by mapping data on the location of coal plants in every country to very fine or granular data on the number of people living in proximity to coal plants. And then we convert this pollution exposure to elevated mortality risks using the latest evidence from the World Health Organization's Global Burden of Disease project on how exposure to pollution concentrations elevates mortality risks for various heart and lung diseases. And then we monetize these health effects. The OECD did a very substantial meta-analysis of several hundred studies to estimate how the value of life varies with income. So we have using that we can quantify different countries' trade-offs between money and health risks. And then finally, as part of this project, we assembled a very detailed country-specific database on emissions factors for different fuels. So that's used to convert these damages into charges per unit of fuel. And then, so for a paper that we've been doing for the new climate economy, working with James Ridge and others, we've been trying to use these estimates of the non-CO2 externality benefits to quantify the ancillary benefits of carbon pricing. So precisely what we're doing is we're estimating what we call nationally efficient CO2 prices. So that is the domestic externality benefit per ton of CO2 reduced from carbon pricing, net of any internalization of those externalities through fuel taxes or compounding of those externalities through fuel subsidies, but we're excluding the carbon benefits, so there's zero value attached to the carbon benefits. So this is entirely what is in countries' own national interests to do. Now, clearly, they should be addressing these broader externalities, air pollution, traffic congestion, and so on, through other policies, obviously. But to properly internalize the externalities, they need comprehensive charging for the air pollution and charging for the traffic congestion and so on. And there's no country in the world that comes anywhere near close to internalizing these externalities yet. So, we think it's entirely appropriate, and it's correct according to the the standard Harburger formulas for the general equilibrium welfare effects of carbon pricing. It's entirely appropriate in the interim to net out the ancillary benefits whenever you're trying to measure the welfare costs of carbon pricing policies. So these are our estimates of the nationally efficient CO2 prices for the top 20 CO2 emitting countries, the appropriate prices to charge for the ancillary benefits. And they're very, very large. I mean, on average, weighted by the emissions, they amount to $55 per ton of CO2. That's a very big number. That's a lot larger than the central estimate of the United States recommendation for the social cost of carbon, $35 per ton. $63 per ton in China, $36 per ton in the United States. And for most of these countries, these ancillary benefits are mostly driven by the air pollution benefits from reduced coal use, the reduction in premature deaths. Saudi Arabia is a bit of an odd case. They don't have any coal, so these ancillary benefits are reflecting reduced vehicle externalities, reduced traffic congestion, accidents, and local pollution, and also reduced distortions from the heavy subsidies for petroleum consumption in that country. But in addition, I mean, not surprisingly, these ancillary benefits differ dramatically across countries. I mean, for example, Italy and Brazil, the ancillary benefits are less than $10 per ton, because these countries don't use a lot of coal. And in addition, our rough estimates of corrective taxes on motor fuels for these countries are in the same ballpark as existing fuel taxes. So this obviously suggests that it's efficient to have differentiated prices on carbon emissions. The conventional wisdom is that we want to price carbon emissions at the same rate across countries. But that's not the case when you account for the ancillary benefits, which I think you have to. We want higher prices in countries with higher ancillary benefits. So we calculated what would be the reduction in the net benefits if we achieve the same reduction in CO2 emissions as under nationally efficient carbon pricing, which is 13%. How about we achieve that same 13% reduction in CO2 emissions across the top 20 emitters through a uniform carbon price? And the net benefits go down significantly, 20%. But that's not a dramatic reduction. It's significant, but it's not dramatic. So I don't want to overstate the case for differentiated pricing. But there are a handful of countries, Australia, Italy, South Africa, Brazil, Canada, for which the nationally efficient CO2 prices are well below this uniform CO2 price, and therefore they end up with net losses rather than net benefits under the uniform pricing scheme rather than the differentiated pricing scheme. And then just finally, we did some very crude back-of-the-envelope calculations of how these net benefits would change when you take into account interactions with the broader fiscal system. So all we're doing here is we're assuming that the efficiency gains from recycling $1 of carbon tax revenue are 25 cents in all countries, with 60% of that efficiency gain coming from reductions in factor tax improved efficiency in factor markets due to reduced taxes, and 40% is coming from reductions in distortions from broader tax sheltering activities like black market activities, people spending too much on tax-preferred goods like housing. Because we don't have good information on the efficiency costs of taxes for a lot of countries. This is just a rough rule of thumb based on U.S. what we think is reasonable for the US data. And, as we discussed yesterday, you get the double dividend. That magnifies the net benefits by about 100% on average. And that's because the efficiency gains from revenue recycling are significantly larger when you take into account the full range of distortions created by those taxes, not only the factor market distortions, but broader tax sheltering. But I don't think we should overemphasize that result, because the key finding from all this literature, the key point not to lose track of, there's been a lot of papers on this, papers that I've done with Larry and Rob, and Gib had a paper with Don Fullerton. And the key critical point from this literature is the critical importance of revenue recycling. If you're going to raise a new tax and raise a lot of revenue, you have to use that revenue productively. If you're not, if you're going to return it in lump sum transfers, or you're going to do a trading system where you just grandfather all the allowances, that's bad news, because in all cases here, the efficiency gains from correcting the ancillary benefits are outweighed by the efficiency losses from the tax interaction effect. So underscoring that you need to make a productive use of environmental tax revenues. So just to conclude, carbon pricing is potentially very strongly in countries' own interests. You don't need to wait for some international agreement. Unilaterally, countries can move ahead with carbon pricing, and the domestic externality benefits easily exceed the mitigation costs. But you've got to exploit this fiscal dividend. We wouldn't recommend a tax if you're just going to squander the revenues by not using them to increase economic efficiency. In fact, when you compare a tax where you squander the revenues with other instruments, on efficiency grounds, it's better to try and use a non-revenue raising instrument like a package of fee baits or regulations to improve energy efficiency and reduce emissions intensity. And then just finally, this point that differentiated carbon pricing seems to be a better approach than forcing everybody to have the same uniform price on emissions, most obviously because the ancillary benefits differ across countries, but more broadly, maybe countries have different fiscal needs. Some countries, so it makes sense for countries to be negotiating over a uniform carbon tax or price, and then, but with countries having the flexibility to go further than that, and they want, if they have substantial revenue needs, or more generally, if it's just politically easier for a particular country to implement high carbon taxes relative to other countries.